Really, Max is going to be focusing on specifically private equity and infrastructure today. And certainly we hope that he will shed some light on it in terms of our actions. So without any further ado, I'm going to hand over to Max. He is dialed in from London, from the Goldman Sachs offices there, and it's great to have him on the line. And yeah, good morning and welcome, Max, and thanks so much for making the time to speak to us today.
Oh, thank you, and thank you for the invite. So let me start by introducing a little bit our group. So I sit within Goldman Sachs in a division that has been doing private direct investments since the late 80s. In that division, we do private equity, private debt infrastructure, and real estate. And we invest both Goldman's money, our clients' money, and our employees' money in these asset classes. My role within that group is across the whole of EMEA, what we call it, so Europe, Middle East, and Africa, to speak to our clients, both institutional clients, family offices, private wealth. And as mentioned, when you're looking at trends, themes in asset management, if your client base is anything like ours, you must, over the last couple of years, have been getting more and more questions about, private equity, private debt, infrastructure. What are these asset classes? Why are they important for us to consider? And those questions will, range from the very simple, what is private equity, what is infrastructure, all the way to the harder ones of, hey, if I wanted to invest in private assets, where should I be putting my money, in the post, hopefully COVID, post 2021 world. Now, the asset classes are very complicated, and there's a lot of materials to cover. So in the next, let's call it 10, 15 minutes, what I was hoping to do was to go through a couple of those questions that we're hearing from our clients, and have a discussions and introduce both asset classes to you. Now, if I'm able to move, there you go. So if we start with private equity, if we start with the basics, what is private equity? We put here a simple, accurate, and fairly useless definition. If you look at it, is private equity is when you are investing in assets or companies that are not public. Very obvious as a description, but the reality is, the question that most people really are asking when they're asking what is private equity is why does it work, right? If you look at the financials world, a bad idea usually happens once, people lose money and they disappear. Private equity has been around since the mid-'80s. It's something that has grown year after year after year. It's an asset class that we'll see later has continued to generate returns in differentiated ways. So what is the genesis? What is the theory behind private equity? And I think when we distill it to its core, the way in which we try to describe it is, if you are investing through a private equity manager, what you really focus or you're really looking for is sort of the ultimate alpha, right? If you think about public versus private, the genesis of private equity was the idea that a private equity manager can buy a company, take it away from the public, from the public objectives, or buy a company from an entrepreneur that maybe started it and grew it to a certain point, but the company really needs professionalization, really needs help to get to the next level, needs more capital, needs a better capital structure, maybe more talent, better, operations, find clients more globally, whatever it is. What you're buying when you're buying into those, private equity themes is somebody who can recognize those thematics and then source those opportunities in a differentiated way, grow those companies, and then eventually sell those companies to whoever is the better owner thereafter, right? So whether it's IPO the companies, sell it to another private equity sponsor that might have different skill sets to continue to grow those companies, or to a strategic who might see a differentiated value to what the private equity investor sees. And that's sort of what's the genesis of investing in private equity, which started more than anything. Once the market really solidified and understood what the value add they were bringing, started a lot with buyouts, right? So buyouts is sort of more based on control, based on all the different levers that you put in order can pull in order to sort of continue to grow these companies. That is the largest part of the private equity market, and is the place where most people, when they're talking about private equity, they're sort of focusing on. Now, the history of buyouts and private equity has changed through time. If you look in the early 80s or sort of mid 80s or early 90s, I think a lot of them was about buying a company, levering it up, and selling it to the next owner in a couple of years after. If you look at the private equity market today, the development since then to now has been amazing, right? Good private equity sponsors have a really differentiated sourcing. They have networks globally where they can really capture, find opportunities that are really valuable. They can see trends as they're looking globally into the opportunities that they're finding. They have full operating teams, they work with in order to improve those companies. They catch on to really interesting trends. So as you all probably heard, one of the biggest trends in the market is the whole improvement from an ESG perspective. The amount of work that the top private equity sponsors can do for their companies in order to get them to the highest standards within ESG has been significant over the last couple of years. And that sort of is one of the reasons why they've sort of continued to generate returns. Now, as always, in an industry that becomes successful, where you find managers that have good track record and real understanding of how to add value, the opportunities expand, and you start seeing offshoots of the sort of traditional buyout. You all must have heard loads of discussions about venture capital growth and distress. We see those as all different flavors of the same thing, right? Whether you're investing in venture capital, where you are at the start of an idea, very, very early on, you're trying to capture what will be the next winner. There, portfolios are very different to buyout in that, you have one or two winners out of a portfolio, a very large portfolio, and those ones basically generate the return. The next step of company development is usually growth. You have, companies that are already have shown a certain amount of their business is proven. They have customers, they have some revenues, and actually they need capital in order to get to the next level fast in industries that are growing very, very quickly. There, a lot of what we've seen over the last couple of years has been enterprise tech, fintech, consumer and healthcare. From a tech perspective, that has been an area that has exploded over the last couple of years, especially with the acceleration of all the trends that we've seen in the digital space, both through the pandemic and into 2021. Buyout again continues to grow. What historically would probably have been, mostly regional, small, investments. You now have buyout managers that do everything: global, regional, small cap, mid cap, large cap. So you can really target the type of risk profile that you're looking. And then finally, you have distress, which distress. Some people put it in private credit, some people put it in private equity. The way in which we think about it is you're trying to get equity-like returns, but you're doing it in a way in which your participation in the opportunity, it doesn't come always as buying equity, right? You might buy the debt and then restructure the company, end up owning the equity and grow it. Either way, what you're trying to do is create equity-like returns, probably with more downside protection. So we put it within, ourselves within sort of private equity from that perspective. So that's sort of the landscape, of the different types of investment, the way in which people invest in private equity, and also sort of the rationale behind it. But the next question we usually get from clients is sort of why the fuss, right? Why such focus in this asset class, and why is the sort of the thematic or the trend continue to increase? So you see at the bottom of the page here, that's sort of the amount of capital being raised. And as I mentioned, year after year after year, we've seen a significant increase in the amount of capital chasing opportunities in the private equity. On the one side, that always brings questions, right? Is there too much capital there for the opportunities out there? And we'll look at that, later on. But on the other hand, one of the things that we need to recognize is that the industry has grown significantly, not just from the type of investment in buyout, but also into growth, value, distress. That has been something that historically not many of our institutional or private wealth clients have been doing, and that sort of increased, and that's part of why there's more capital going into that space. But if you look at the top part of the market, which is looking at buyouts, where you have most of the information and going all the way to mid 80s, one thing that people like, and this is where I think the fuss comes from, is the consistency of returns. And this is sort of what we were talking about before with regards to, a good idea in the financial markets stays there for a long time. When you look at private equity for years has been able to continue to generate returns. And they've been able to adjust to different market opportunities, different trends, different value creation, objectives, opportunities, etc., in order to continue to generate return. Two things to highlight: very big dispersion between the top quartile managers and the bottom quartile managers. So you do have, additional complications in investing in private equity, and we look at that sort of at the end of the presentation. But the other thing is, if you look even at the lower quartile, it's hard to see periods where private equity has actually lost money. So from an absolute return perspective, even though you're taking equity-like risk, you have been able to generate, very, very good returns. When people look at it relative to public markets, there's a lot of academic work. Is it, does it generate alpha or not? When you look at the academic work, most of it says that it has consistently generated, returns once you adjust for leverage and other things like that. There are, of course, certain arguments against that, in the academics world also. So, on the balance, we would argue that there is some proof there that your returns are better than public markets. But even looking at private equity global managers, it's really hard to see any of them who have lost money over the last 30, 40 years. So that's sort of one of the reasons why people are very focused on this asset class. Infrastructure, if you look at infrastructure, it's a very, very different, both history and type of asset. Infrastructure, if you went back to the early 2000s, the institutional capital following infrastructure was very, very small. And actually was pension funds and insurance companies that back then came and said, hey, to a lot of the private equity sponsors, including ourselves, they were saying, hey, at the moment you're investing in these assets, we now call them infrastructure, but sometimes you put it in real estate, sometimes you put it into sort of private equity. Would you do something bespoke for us, in this area? And the rationale behind it was there is a part of the market which are assets that do have a different risk characteristics to private equity. And that was sort of the rationale for creating a different asset class, right? These are assets that are important for society, and therefore they have, downside protection. They have long-dated contracts. They're inflation protected. They have, barriers to entry. All the things that would point towards a much, much more defensive, type of asset than, private equity. And then that was sort of the genesis, and a number of managers before the previous crisis, not the COVID crisis, but the global financial crisis, started looking at infrastructure and creating portfolios. And the start of that market was pretty rough, right? People overpaid, overlevered. There was more volatility than that should have been in an asset class that people were looking at for its defensive nature. And then there was a very big discussion about, what actually is infrastructure and how should we invest, going forward. And since then, the market has sort of exploded, right? It's grown significantly, and we've seen an enormous amount of opportunity types coming into the market for different clients with different risk profiles, to focus on. Historically, infrastructure would have been defined as utilities, transport, and energy, and maybe some social infrastructure. A lot of the social infrastructure has historically been done by, with government guarantees of some sort, and therefore the returns were very, very low and a lot of leverage. Utilities and transport were the place where most people have, spent most of their capital over the last, call it 20 years, with some dips in and out of the sort of the energy from the oil and gas sort of perspective. And as we've seen this big transition between, the all fossil fuels into the renewables, that has been one of the big trends that we've seen, grow. If you look at our infrastructure now, the focus really for most people is less to do with what the asset is and more to do with the risk characteristics, right? So if you're investing in a port is an infrastructure asset by definition, right? It's a port. But if you're investing in a port that has very little barriers to entry, very high, very, very low margins, is unionized, is very dependent on GDP. When a downturn comes, the volatility in that asset is very, very high. So people don't, like that. On the other hand, you might buy a port that is sort of a quasi-monopoly for the country. It's a landlord port rather than a container port, and has long-dated contracts, a lot of stability. People, like that because the risk characteristics are what you want from an infrastructure asset. So a lot of focus has been on that. And then, as you see, at the bottom of this page, as people have become more and more comfortable with the asset class, they basically expanded the type of investments that they're willing to invest. So we've seen the appearance of core, super core type funds. These are funds that are investing in assets that are very, very long term. And what we've seen there is a very significant compression of returns through time. This would be maybe a European utility where the regulations are conducive, the asset is extremely high, income generating, and a lot of the time it gets priced out of a bond rather than out of an equity from a risk reward perspective. You might face a lot of price volatility in that space. The typical example is if you would have bought something like a Heathrow or a Gatwick, right? Very core, very, very, very stable assets. You get hit by COVID, clearly, there is a certain amount of volatility. So there's always regulation and operational risk in the asset. So you always have to make sure that you're pricing those assets appropriately when you're making investments. Core plus value add, those will be assets that are, in the equivalent for real estate, it will be sort of the build to core type assets, right? These are, you might invest in a port in Europe that has a terminal, but it needs to build another terminal and has long dated contracts that when you build the other terminal, corporates are using your port facilities, right? So there, you're not buying a long dated cash flow generating type asset. And there's where we see a lot of the focus from our clients, trying to generate that 8 to 15% return. So a bit lower from a gross perspective, a bit lower than private equity, much more downside protected, but you're not going all the way to debt type equivalents. And then you have sort of the more opportunistic equity investments in infrastructure where, you're doing a pure build out of something where there's very little track record, historical analysis in order to really know how much the usage is going to be. We position those ones more like a private equity than infrastructure because all the characteristics mentioned on, downside protection, barriers of entry, etc., might fall down to a certain degree. So, we're very cautious about sort of that part of the market, except if you are pricing it as a private equity, and then you put it, we put that under private equity. If I look at the two asset classes, the continuation in growth has been very significant in private equity for many years, as we said. Infrastructure has been, meteoric, right? The growth from 2008-9 to today has been, incredible, and we expect it's going to continue. If you look at the institutional following of this asset class is incredible. If you look at Europe, for example, the regulator has put a lower capital charge for these assets for insurance companies than private equity. So there is a lot of trying to make sure that risk profile is adjusted when people are making investments, and that's attracted an enormous amount of capital into this space. Now, both asset classes, there's less of a history in infrastructure from a return perspective, but historical performance, at least over the last two cycles, over the first one, with the global financial crisis, we saw a little bit more, as I mentioned, more volatility than we would have wanted. Over COVID, it's been great, right? There was some volatility in parts of transport like airports or in the part of oil and gas if people were doing that. But reality is most people have moved away from oil and gas, over the last couple of years in infrastructure because of the volatility in the market. And the volatility in the airports, I think, is much more muted, and long term people are seeing the value of the infrastructure value of airports. So there's not a real issue there. So as an asset class, it's behaved really well. So private equity, hard to find managers in global portfolios at least that have lost money through many years. In infrastructure, much muted volatility and really good returns over the last 20 years or so. So two asset classes that when you look back, both look pretty good. Now, what happens when you look forward, right? So, the premise is still the same. The premise is if you are investing in private assets and you believe in the alpha that managers can create, you should be able to find companies and themes and trends that are, good places for capital to be deployed. Now, that is most acute in the moments of greater volatility or greater change. And that volatility can be two ways, right? On the one side, you can think about, market crash where, everything, all pricing goes down, and then a private equity sponsor, if they've got capital, they can come in and buy assets. Reality is in those moments, think of the height of the crisis in 2009 or March last year, the number of transactions that happen falls down. So there, yes, you can get great deals, let's call it, but the amount of flow is smaller. Where private equity or private infrastructure, real estate, etc., really capture that ability to innovate and flexibility and nimbleness is hopefully in periods of great change, like what we're seeing now, right? So if you think about the COVID period and the acceleration of trends, right? The changes in consumer behavior, the focus on renewables and ESG, all the changes in the healthcare part of the market, all the changes in supply chain disruptions, travel issues, changes in retail, all these are opportunities that should bring great chances for private equity and infrastructure investors. So I give you a quick example. If you had looked at infrastructure investing in 2005, 6, 7, when the market was starting, digital infrastructure would not have featured in anybody's portfolio. It was seen as outside of the market. If you look at it now, digital infrastructure is at the core, right? And if you think about why, well, digital infrastructure is part of the whole digitalization of the world. It's so important for society now that you need the full build out that you're going to have over the next couple of years in order to stay ahead of market opportunities for the whole for every industry in theory, right? So it's finding those trends, opportunities, and private capital has been able to sort of continue to deploy into these areas. All the things that come behind that, right? Whether it's changes in every corporate, whether it's where are we going to live, right? So if you can work remotely through digital, interfaces, do you really need to, live in the same places? How are you going to buy stuff? How are you going to move things around? So logistics changes, data centers changes. There's a lot of, opportunities for capital to be deployed across the market. So that's one of the things, when we look at the market at this point in time. On the one side, you have very low interest rates in many places around the world, very high public asset valuations in certain areas. Of course, that's to be discussed whether people believe it's too low, too high, etc. But what it does create is really good opportunities with all these changes happening for private market, and that's what's resulted in a lot of capital being moved or chasing the private markets opportunities. So that would be, what's the fuss number two? The first one is looking back, performance has been great, returns have been stable, etc. What's the fuss number two? Well, going forward, there seems to be a lot of really interesting opportunity for private markets to capture, returns. ESG, we had to mention this here because it's such a strong thematic. Every discussion that we're having at this point in time has ESG from an investing perspective as part of the process. It's something that is paramount for our clients, for ourselves, for our regulators, for the corporates we work with. So it's very, very important that it is understood that as part of the private investing, you should be very, very well positioned, not just to vote from outside, but actually to affect change from the board and really make a very, very big differentiation, both on existing assets that you buy or on finding trends and things and opportunities where you want to deploy your capital, right? Somebody mentioned here, it's not about making, turning every company into a onshore wind farm. That's not the case. But making sure that all your investments become the most from the best they can be from a sustainability perspective, making sure that you find something that does have potential, positive impact in the world and grow it. Those two things have been very, very valuable, and it's something that we're extremely focused on and our clients are extremely focused on. And then the final question that we get, a lot from our clients, and I'll stop after this, is, so what are the considerations for me, right? I've always done public market. Public market seems to be very different from private markets. What should I be thinking? You're telling me great returns. You're telling me, it's going to be, the great investment opportunities going forward. But what should I, focus? And I think, for people coming new to this asset class, what we're trying to focus them mostly is things like, cash flows considerations, right? So basically everything to do with risk, right? So cash flows is the first thing that is very different. In public markets, if you want to invest in, UK equities tomorrow, you put a phone call, as long as you got your operational side appropriately, you just get into the market. In the private side, you have to pick a manager. The manager then will invest over 3 years, and then they'll start giving you money back a couple of years later, and then you don't have any liquidity other than using maybe the secondaries markets to sell your interest, which is something that is very, very alive in the market, but it's something that people consider as a second step. Therefore, you have less liquidity and you have more considerations of cash flows. From a volatility perspective, private markets usually have lower volatility and less of a drawdown. We saw that again in 2021 at the height of the March period. If public equity has gone down by like 30+%, depending on the index, private equity managers probably went down by like 10%. And there's always a lag on valuation. So those kind of considerations are very important. And then, the one that most people also focus on is cost, right? Accessing the private solution has a higher cost from management fees, and therefore one of the things that we always try to understand from our clients is expected return, volatility, costs, and then what does it create from a net perspective on a risk-adjusted basis relative to what you can see there. And maybe I'll stop there. I know that you guys were a little bit delayed, so I don't want to take up too much time. So I'll stop it there, and if you have any questions, please let me know.